If you own your employer stock within your 401k, then this video could help save you thousands of dollars. Individual results may vary, and this is not individual advice, so consult with your CPA and your financial advisor or CFP after watching the entirety of this video. I'm your host, Eli Freeman. I'm a certified financial planner, and this is Data Brief, where we break down the data behind investing so that you can make better decisions that are based on data and not feelings. As always, let's look at the data. Net Unrealized Appreciation, or NUA, is a tax strategy that applies to company stock that is held inside a qualified retirement plan like a 401k. NUA is simply the difference between what you paid for the stock, which is your cost basis, and what it's worth today. That difference is the quote gain. Normally, when you take money out of your 401k, every single dollar is taxed as ordinary income in the year that you distribute. But if you utilize the NUA treatment, the tax rules actually change from that. Instead of paying ordinary income tax on the full value, you only pay ordinary income tax on the cost basis of the stock at the time of distribution. The appreciation, which is the gain above that basis, is not taxed immediately. Instead, it is taxed later when the stock is sold at long-term capital gains rates for the initial gain. As a side note, there is an interesting tax provision which states that it will not be subject to net investment income tax, which is the extra 3.8% tax for high earners that's on gain, but that's just a side note. All gain after the transfer is its own new gain, which will be short-term or long-term depending on how long you hold on to the stock before selling and after NUA. I will put a picture illustrating this on the screen, and it will probably help you for reference to understand that. That difference in tax treatment, the NUA versus a regular 401k, really can be significant for different individuals, but not for everybody. Now, in order to qualify for NUA tax treatment, there are several strict IRS requirements that you have to follow. The first is that the distribution must be a lump sum distribution. That means that the entire balance of the retirement plan must be distributed within a single tax year. Second is that the distribution must occur after a triggering event. These triggering events include separation from service, reaching age 59 and a half, disability, or death. And the third is that the stock must be distributed in kind. In other words, the actual shares of the company stock must move from the retirement plan into a taxable brokerage account. Typically, when completing this with your 401k plan, they will ask for your brokerage account's information to directly transfer the stock, things like the DTC number of the brokerage account. You cannot sell the shares inside the plan and still qualify, and this is huge. If someone recommends that you diversify your stock in your 401k before checking the basis, and you're approaching retirement or over 59 and a half years old, you should probably hesitate. You may be missing out on this special tax code. The fourth is that the rest of the retirement assets must also be distributed. Typically, this means rolling the non-stock portion into an IRA while transferring the stock to a taxable account. And finally, the cost basis of the stock becomes taxable as ordinary income in the year of distribution, and you just need to know that. And that's really not optional. That's part of this deal. So why would you consider using NUA, and who's it for? Well, let's start with the pros. The biggest advantage is potentially lower taxes. If the stock has a low cost basis and significant appreciation, you're converting what would have been ordinary income into long-term capital gains. And that could be a meaningful difference, likely shifting from something like the 22% tax bracket down into the 15% capital gains bracket. Another potential benefit is some tax flexibility. Once the shares are in a taxable account, you control when you realize the gain. That means that you can strategically sell shares in years where your income is lower. Also, for some with limited taxable assets, this can be especially powerful for retirement. It creates flexibility for income planning, especially in those early years of retirement, by distributing from a source that is not fully taxable as ordinary income. It can also tie directly into healthcare planning for strategies before age 65, where managing taxable income can impact insurance costs. If you're curious about how to save money on your insurance costs before you're age 65 if you're early retired, I've created a video for this that's titled, "What do I do for insurance before 65?" That will show you how you could potentially save $20,000 a year or more if you structure your income correctly before you're age 65. And there's another benefit that's overlooked: charitable planning. If you have a highly appreciated stock, NUA can pair very well with a donor advised fund because once the stock is in a taxable account, you can donate shares directly instead of selling them. That allows you to avoid realizing the capital gains that are on the donated shares. For example, if your cost basis was $70,000 and you plan to give $35,000 per year, you could donate a portion of the highly appreciated stock. That donation can help offset the taxable income that was created by the basis that was being recognized in the year of distribution. So at the same time, you're reducing concentration in a single stock position within your portfolio. And in the right situation, NUA doesn't just create tax efficiency, it can also enhance a long-term charitable giving strategy while improving your portfolio diversification. But there are trade-offs, and the first is the immediate tax hit. You will owe ordinary income tax on the cost basis in the year of distribution. If your basis in the stock is high, it can push you into a higher tax bracket than what you want to be in. And for those ages 63 or over, that could also trigger higher Medicare premiums. The second reason is once the stock is in a taxable account, all future dividends and gains become taxable. That introduces an ongoing tax drag that wouldn't exist inside a retirement account where dividends are not taxable when paid. The third is managing the timing of capital gains can be a complex thing. You will need a thoughtful strategy to avoid unintended tax consequences that happens over multiple years. Fourth, this can make diversification of a large single stock position very difficult. You know that if you sell the stock, it is immediately taxable, whereas if you roll the stock into an IRA, it is not immediately taxable and can allow for a well-diversified portfolio without that tax whenever you make the change. So when does NUA make the most sense? Well, the data suggests, according to Keaches in his article 401k, Net Unrealized Appreciation rules aren't always a great deal. It works best when there's a large gap between the cost basis and the market value. In other words, low basis and high appreciation. That's where the tax arbitrage is strongest, and someone can likely benefit from the NUA treatment. On the other hand, if the appreciation is modest, the benefits of NUA shrink. In many cases, rolling that stock into an IRA may be the better option. That keeps the assets tax deferred and avoids that ongoing tax drag that I talked about earlier. Bottom line, NUA is not a one-size-fits-all strategy, but in the right situation, it can be a powerful tool for reducing your lifetime taxes and increasing flexibility. So for the most part, with some exceptions, the right situation for the NUA treatment is if the basis in your employer stock is low because the stock is highly appreciated. But the key is understanding the rules and running the numbers, because when it comes to strategies like this, it's really important to look at the data. If you find information like this helpful, we run analysis like this consistently for our clients' specific situations. If you're interested, head over to Mach 1 Financial Group's webpage if you'd like some help looking to see if this makes sense for you.